cloud, share screen. There we go. So sponsor, what is a sponsor? And you're going to hear sponsor used in a couple of different ways. But first, let me read this disclaimer. We are not investment advisors, and this is provided for educational and entertainment purposes only. Any and all investments that you get involved in involve a degree of risk. You know, before you get involved, make sure you assess all that risk as being appropriate for you. Talk to your investment advisors, and don't invest any money on any of our recommendations alone. Always consult your professional advisor before moving forward. So hopefully that'll keep our lawyers happy. So what is a sponsor? And even I've been confused on this from time to time because I've heard it used interchangeably in a couple of different ways. When I looked up the actual definition, it states that a real estate syndication is a transaction between a sponsor and a group of investors. And as the manager and operator of the deal, the sponsor invests the sweat equity. So what this is telling me is that the sponsor is the general partnership, whether it's one person or a number of people. This includes scouting out the property and raising funds. In addition, the sponsor acquires and manages the investment property's day-to-day operations, and then I'm sure it also includes the disposition when the time comes. But I've also heard the sponsor known as the person who signs on the loan for the purchase of a multifamily property, or what I would now have to call a loan sponsor, or a loan guarantor, or a loan signer. So I've heard both terms, and we're going to sort of bury the loan sponsor into the larger syndication sponsor role, because I think that as you look at different sponsorship groups or different syndicators, they tend to include signing on the loan as part of the GP, which is part of the real estate syndication group. So that would fall under the sponsor's hat, but it's not the only duty that a sponsor has. So with that definition as a sponsor, it sort of opened up my mind a little bit to be not just focused on who signs on the loan and who puts their balance sheet up. So what does the sponsor do? Well, and a lot of you already know, especially those of you who have mentors and have worked with other national teams on learning about multifamily. But they find the property. They do the due diligence. They find the property. They work with the brokers. They submit the underwrite. They develop those broker relationships. They find the deal. They underwrite the deal. They submit the letter of intent. They go through the due diligence period. They get the financing from the banks, and then they close and take over the property. That's a lot of work. And really, for most successful sponsorships are done by just a handful of people. Unless you're into the thousands of doors, then you have a larger team. But generally, a lot of the successful people I've seen who are doing this business, there's somewhere between 2 to 4 people in the overall partnership that are doing all of this work. So that's a lot of effort. That also includes finding the investors and managing the investor base. So it also includes the loan guarantor. Someone has to sign on the loan from the bank. And the bank won't just take anybody. If you're a new person in the multifamily space, and let's say you have $100,000 to your name, but you're trying to buy a $15 million property, the banks are not going to give you the loan to buy the property, even if you had an 800 credit score. You've got to come up with someone who has a net worth equal to the loan balance at closing and can provide a certain amount of liquidity equal to about 10% of the loan balance. And in a lot of cases, they want to know that that person also has experience in the multifamily space and or lives close to the property. So when you're looking at a loan sponsor, these are the minimum things that they have to do. One, they got to be willing to sign on the loan. Hopefully you're looking at a non-recourse loan, which means if the property defaults on the loan for reasons other than you did something illegal, then they can't come after the person who signed on the loan. It'd be hard to find a loan guarantor who would sign on a loan that he has to put up collateral in order to get the loan. And then on a $15 million property, if you're putting 20 or 25% down, they've got to have a net worth, greater than $10 million in order to get that loan. And they have to have liquidity equal to about $1.5 million for a $15 million loan. And the bank's going to come back quarterly or semi-annually or some periodicity that's convenient to the bank to make sure that that liquidity is still there during the entire ownership of the property. So it's not like you can just say, hey, I've got my $1.5 million here and then spend it on something else, because you're going to have to be able to reproduce that at the bank's request whenever they request it. And then you got to have experience. So for most of us in this space, we need to go find someone with that experience and have them agree to partner with us in some way, shape, or form, which means you have to develop a relationship with that person. They've got to be able to trust that you're going to be able to do a lot of the other things that we've talked about that the general partnership has to do. They're putting their name at risk out there in the multifamily arena. Also, the general partnership or the bigger sponsor has to do investor relations. You have to generate interest from passive investors. You got to secure commitments for them to send in their money to fund your deal. And then you have to maintain regular communications with those folks during the ownership. Whether that's a weekly or a monthly or a quarterly call, plus sending them any additional information by email, whatever it's going to take to keep them apprised of how things are going. It's more than just writing them their check every month or every quarter. And if something goes bad, if there's a fire in one of the units or a shooting or something, then that's extra communication that you have to have with the investors, just to keep them informed as to what's happening at the property and to give them a sense that you know how to manage this property. So, you want to be able to treat your investors well, and investor relationship is an important part of what the sponsor has to do. We talked about, as an asset manager, it's not just, all right, I bought the property, I collected my acquisition fee and turn it over to a property manager. Now I can go away and wait and just collect checks. You have to manage that property manager, and that's called asset management. You got to manage the property by implementing a business plan. You got to set a budget for each of the major line items in the income and expense sections of the income statement. It's not enough to just say, I want maximum rents and minimum expenses. You got to talk about how much are taxes going to be? How much is insurance? Are we shopping insurance? How much is repairs and maintenance? How are we doing on maintenance requests? Are we satisfying them, fast enough, or are they going too slow, or are things not getting done? Does the property look like crap, or is the property being kept up? How many people are coming in, looking to rent from us, and how many of those are converting into tenants? And why is it that number so low or so high? So you got to set performance targets. You have to set actual dollar budget targets for them to meet. And then you got to stay on top of them every month to make sure that they're working to meet those goals. So that's why you get an asset management fee, because someone's got to, that takes time and effort to do that. So you got to be paid for that. Conduct weekly performance reviews, occasionally go visit the property. And I suggest surprise visits to the property. That way that if they know you're coming, they're going to have things cleaned up for you, and that'll mask any potential issues. On top of what the property management company does, because they will analyze the market if they're a good property management company, and they'll know where rents need to be. But you should be doing the same thing independent of the property manager, so that you understand what's happening in the market and can track along with the property management company, but be independent of them. And then address issues as they arise. The property manager, if there's a fire, odds are they're going to know what to do, but you're going to be the first call they make. And so you need to be aware of what, has to happen, and you got to work in partnership with the property manager to make sure that the issues are addressed properly to the benefit of you and your investors. So how is this sponsorship or this sponsor compensated? And you'll hear complicated terms like waterfall and capital stack and a bunch of other things. Really what it is it's how do you split up the sponsorship's portion of the deal? Um, when you have a syndication, you generally have the general partner or the sponsor, and then you have the limited partners who are the investors. And typically, I'm just going to say typical, but it can range anywhere from 50 to 80%. The investors or the limited partners will own somewhere between 50 and 80% of the deal. And then the sponsor or the general partnership will own the balance. What you're looking at here on this screen is how do you split up that balance, that 20, 25, 30, 35% that the sponsor is entitled to for going through all this effort to make money for the investors. So if you're the person doing the due diligence, the equity split can be, and all these numbers are negotiable. This is just notional. If you go out online and look up, you're going to see different numbers in these categories. But people that are doing due diligence could make as much as 5% of the general partnership. If you're the one out there finding the deals and taking it through to closing, as much as 20% of the deal. The person who signs on the loan depends on how involved they need to be based on the bank's requirements, somewhere between 5 and 20%, but I've seen some loan sponsors take as much as 50% of the deal. So it's whatever you can negotiate. You can't get the deal without them. At the same time, you can't have them take you to the cleaners either. A bad deal is, for you is not necessarily a good deal for everybody else. So you just got to keep that in mind. You got to work with sponsors who can be reasonable. The person who raises money or the people who raise money, can be allocated as much as 35%, and that can be split if there's multiple people raising money, depending on the amount of money they raise against the target. If you're going to do a $2 million raise and 2 different people bring in $1 million each, they'd split that 35%, 50-50. So what is that? 17.5% each. And then asset management, the sponsorship's going to take a 1% asset management fee, but the asset manager should also be taking an additional amount of money because they're also going to be going through the refi. If there's a refi while you're holding the property, they're also going to be the ones that have to prepare the property and the books for selling when it comes time to sell the property and all those other things that I talked about earlier. So you can see the asset management between 20 and 35% of the equity split as well. So this is what a sponsor is per the official definition. I was under the impression it was just the person who signed on the loan. I was wrong. Happy to have learned a little bit more here on this one. So Roman, thank you for bringing this one up because I learned something. So that's good. And does anyone have any questions based on what we talked about here today?